With world-class expertise and local insight, Dexus creates value not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, and welcome to the COB on this Monday afternoon from all the team here at AusBiz. I'm Nadine Blaney. It is the 19th of May, and there's a little bit going on out there, but primarily we're now focusing on what we can expect from the RBA tomorrow. So we had expected to see some pressure being put on this market, and that happened when the market opened up. Saw a little bit of a comeback around the 12:30 mark, as you can see, even pushing higher than we had been previously to close the Friday session. But then, what happened? We saw some China data come through, and disappointing. China's factory output, did slow, showed some resilience in the face of tariffs, but retail sales did slow, and China's also really struggling to lift home prices. There was no growth in China's home prices, and April refinery output fell 1.4% year on year. Not only that, but I've been keeping an eye on U.S. futures throughout the session, and we've got a lot of pressure being put on NASDAQ and S&P 500 E-minis in the U.S. So I think that just sort of combined to bring us pretty lower than we had been all day to end. That's the COB Australia Index. We've got the S&P ASX 200 down by 0.7%. All right, so what are the key themes? I think I touched upon it. We did snap that winning streak that we had been enjoying here in Australia. A lot of that has to do with our China connection, which runs very deep. So we have seen some pressure being put through on the miners today as well. And then we get to the interest rate story, widely expecting to see a 25 basis point cut coming from the RBA. I had a great chat with Justin Fabo, who is the chief economist of Antipodean Macro, I think it's called. Yep, it is. And look, he says it's pretty much a sure bet that we'll get that cut coming through tomorrow. And then we had a good chat about whether the RBA actually risks even moving too slowly when it comes to cuts. And I asked him what he would want to hear from the RBA. If he was face to face with Michelle Bullock, the governor, what he would want to discuss with her. So you can listen to that interview. You'll find it online at ausbiz.com.au. Boy, we've had a number of really great expert guests join us today, and some special interviews as well from the SIAA, so the Stock and Investment Conference that was being held in Sydney. It's a 2-day event. It's going tomorrow as well. We spoke with Lucy Ellis, who's formerly of the RBA, and she's now chief economist at Westpac. Andrew had a good chat with her. That's up online if you'd like to have a listen. I also spoke with Armina Arms Rosenberg from Minotaur Capital. Really pleased to have the chance to speak with her. So we'll put that in the newsletter as well for anybody who may have missed it. AI, using AI to invest globally. It's fascinating. And I actually was lucky enough to see the AI software demonstrated. Was incredible. All right, let's get to some of the sectors underperforming. And there's not very many that outperform, but we'll do our best to look for one. Energy was a real sore spot for the market overall. We did see refinery output in China falling 1.4% year on year. Oil prices, though, really slipping as we see those China concerns weighing along with that of the U.S. And again, we can see the China story being expressed here. Fortescue off by close to 5%. Rio down by 1.6%. In the tech space, Xero was a beacon of light at $180.77 market close. And sector-wise, we did see the telcos actually overall outperforming. So the likes of Telstra, TPG, and Superloop. Had a lot of conversations about Superloop, up by 2% to $2.52 today. Let's get across some of the news out there. And Mineral Resources has appointed Malcolm Bundy as non-executive director and board chair. Domino's ANZ CEO Kerry Hayman will step down get this, she's been with Domino's for 37 years. And Dicker Data, so David Dicker is stepping down as CEO of the company he co-founded. Now, I know that one of our viewers, our regular viewers from the call, wrote in to ask about that one. We'll endeavor to get you an answer from our expert guests ASAP. I think the person was asking, what does that mean for the company? I know that a lot of us really love founder-led companies. So yeah, we'll bring you some analysis, but interesting to see the share price rise 2.25%. Now, a bit of earnings. So Gentrack, it is a New Zealand company, software solutions actually, reported half-yearly result, revenue at $112 million, up by close to 10%. Dexus has dipped. That is on, all of that conjecture around its airport stake. Morgan Stanley is doubtful that the fund's platform could be forced to sell its stake in Melbourne Airport and Launceston airports because of allegations of a confidentiality breach. And Prenti, its subsidiary, has inked a big contract with Goldfields, $500 million to provide underground mining services, and I think they've got the option to extend as well. So look, it wasn't the biggest day on the corporate front by any stretch of the imagination, but I think it does get more interesting when we look at the macro, and because of that, very pleased to welcome my friend David Scott from StoneX. You might remember back in the day, Scotty, when we used to do this very podcast together. So why don't we run it just stomps. Got it. Why don't we run it like we used to? So when you looked at that China data today, Scotty, what was your first thought?
Tepid and a bit surprising, I'm going to say, particularly when it comes to the industrial production number. 6.1% year on year, obviously a bit of a step down from what we saw in March, but still very strong and still outstripping what we're seeing when it comes to retail sales as well. So the read through to me is that, well, clearly there's still a lot of overcapacity in China, and that means that it's got to go and move that overcapacity somewhere else. And unfortunately at the moment, that's probably not the United States. So EU, other parts of the world, and that might be another story for another day when it comes to potential trade tensions down the line. Okay,
so that's China. That was the sort of news of the day. But we are still digesting the fact that Moody's has downgraded the U.S.'s credit rating. It's been pointed out to me a couple of times today that it's not, coming out of left field. We've got other downgrades already on the table. So what was the market reaction, and what does it tell us, the fact that there wasn't massive market reaction to that?
I think everyone is probably, the biggest surprise was that it took so long for Moody's to go and catch up to what Fitch had done a couple of years ago, and of course S&P back in 2011. There has been a bit of a reaction, and you can't just go and dismiss it, because there has been, particularly at the back end of the US Treasury curve. We saw 10-year yields going push up above 4.5%. We saw 30-year yields as well going hit 5%. Now, that's getting back to the levels we saw during that peak panic about a month or so ago, when it was all about that sell America trade. Now, not the same velocity of the move up on this occasion, but clearly there's some concern out there, particularly when you talk about the big bill, which is being sent through now, got passed through the House in the United States today, and now goes on to the Senate. So we'll see where that gets to, but that's going to go and add more to the debt loading and potentially go and add to, more pressure on treasuries and also the US dollar.
Yeah, so again, this is the bond market expressing its angst, do you reckon?
A little bit. So what you're looking at there, that chart basically got your 2-year yields on the left-hand side in the States. You've got 10 years, 30 years, and then the 2's 30 curve. And you can see at the moment, particularly, there's been a really big increase, that back-end rates. So that reflects there's concern out there. The term premium to go and hold US Treasuries is increasing at this point in time. It's not being driven by inflation expectations by any stretch. This is insurance that is being demanded from the market. So keep a close eye on this, because even though the US doesn't have a AAA rating anymore, it still trades as the premium safe haven benchmark, in my opinion. So everything else trades at a spread to Treasury. So if it is trading here at 5% for 30 years, that's going to pressure asset valuations elsewhere. And so that's something that the market needs to be concerned about right now, given how fast and how far risk assets have run recently.
Okay, and so you reckon that maybe if we just take US equities, maybe US equities are overbought, or it's hard to sort of get your head around what's happening there, because there's still so much yet to be done, I suppose, from this new U.S. administration, including Trump's, what is it, the big beautiful bill?
Yeah, the big beautiful bill. It's no, we'll see how that goes. Obviously, it's progressed today, which was a bit surprising how fast it went through. The four holdouts obviously flipped pretty aggressively. What they got in return, we don't know right now. Back to the original question, though, about what the implications are for markets. I don't think it's just the US equity market. I think you could go and put our market and a lot of others around, particularly in the equity universe as well. We've just moved so relentlessly higher so quickly, and we've priced in so much good news. And so when you look at what's going on with safe havens like treasuries that are bumping up 4.5–5%, and you look at what they're offering relative to other parts of the market, it is a little bit of concern. And sustainable bull markets, I made this point to a few people today, clients and the like, sustainable bull markets have pullbacks along the way. This has just been relentless, monotonous move higher rapidly. And I just wonder whether potentially there's no clear signal right now. But when it comes to the risk, clearly, I think now they're starting to skew to the downside rather than upside.
Yeah, right. Okay, so that's a word of caution. When I look down at my screen, my good old market map, we've got energy being hit pretty hard, but also those big miners with China exposure. That's got to be it, with Fortescue down by 5%. I mean, if China's still not firing on all cylinders, it certainly doesn't spell good news for our commodity plays, does it?
Not at all. And when you bring that yield equation back into the mix as well, of course, commodities don't offer any yield. So that's another headwind right there. The iron ore price actually came off well and truly before the data came out today. It was down really heavily late last week, pretty much on not a lot of news. And so that's one worth keeping an eye on. I was looking at the other charts today, sitting on the 50-day moving average. If that breaks, we could see another big reversal coming through. Still holding for the time being, but yeah, I'm not surprised to see that weakness coming through. When you look at the supply side of the iron ore story in particular, and the demand side, property investment in China, double-digit declines year on year in April. That's not really good. It's actually an acceleration of what we saw in March.
Now, we have the RBA tomorrow, as you know, 25 basis point cut pretty much baked in. So what will you be looking for in the communication coming from the Reserve Bank? Because we do get updated forecasts. Correct me if I'm wrong.
We do. The SOMP is released alongside the other statement and the like, and I'm really interested to see what the RBA is going to say when it comes to its growth, unemployment and inflation forecast. When you look at the growth side of the equation, this is back 3 months ago. They had 2% penciled in for June, so they need a pair of 0.55 quarter-on-quarters in Q1 and Q2 to go and get there. Maybe looking a little bit ambitious given what we're seeing when it comes to consumer spending in the first quarter. Unemployment rate 4.1%. This is an average, so to me, there's not going to be any change there. But the key one, the trim mean inflation. Remember, the prior forecast had no return to the midpoint of its 2 to 3% target, that 2.5% midpoint. And that was based on the premise that the market had too many cuts priced into the curve. Well, you fast forward to today, and there's more cuts priced into the curve now than there was back then. So I wonder whether potentially the RBA might go and skew those risks for the trim mean reading potentially a little bit higher than what we saw 3 months ago. And then that will be the storyline. That will be the hawkish cut narrative that everyone's already talking about.
Because we're concerned, the RBA is concerned that inflation won't, this disinflationary pulse, I guess, won't be sustained, even if we see, 10%, say, global tariffs coming from the US.
Yeah, obviously there's a lot of uncertainty, but when it comes to what the risks are to me, the form's on the board, and they went and mentioned that specifically, that they use market forecasts for the rate track, and so they're going to go and use that again, and they've got their GDP and unemployment forecasts are likely to remain pretty much the same or very close to it, at least this year. To me, I'm really interested to see what they say. I suspect that there might be a bit of a skewed upside risk when it comes to that profile track when it comes to trim mean. So we'll see what happens, of course, at 2:30 tomorrow afternoon. And then, of course, the press conference from Michelle Bullock, who I've got to say, compared to what the statement is, which reflects the views of the entire Monetary Policy Board, tends to go and come across as a little bit more hawkish than her companions.
Mm-hmm. Okay, so we will be watching out for that one. Hey, Scotty, so the S&P ASX 200 closing at 8,295, off by 0.6%. What do you make of it technically?
Still on an uptrend, but there's been no notable signal when it comes to, at least from a candlestick or from a market pattern perspective. But just getting back to what we're talking about earlier, it really concerns me just how there's been no real pullback on this bullish run, and there's been so much good news priced in. And if anything comes through to go and make people feel uneasy about what we're looking at right now and how far we've run, you could get rug pulled pretty quickly when it comes to this market. There's not a lot, I think, fundamentally underpinning it. There's just been a lot of people FOMO chasing, and that always makes me concerned. I feel much more better as an investor and a trader if I saw a gradual pullbacks along the way, but we haven't seen that yet. So look out on the downside rather than upside near term.
Look out below. Scotty, thank you. Hope you have a good evening there in Adelaide. Well, let's get back to stock specifics. Today, the stock of the day on the call was New Hope. Now it's a coal miner. Gaurav Sodhi from Intelligent Investor and Nathan Somasundaram from Deep Data Analytics weighed in.
It's the least complex operation out there. And I think the demand for coal in an environment, slowing global growth environment, is going to remain relatively solid. And this is not your steel production play. This is just energy demands, right? And that's going to remain relatively well supported. And any kind of energy shock, which I think right now, energy prices overall are pricing in almost a recession. So the market is at all-time high, but energy prices are pricing in a recession. So one of them is wrong. You assume somewhere in the middle, energy should do better. I think if you're looking at returns, you want defensive yield plays, this is one of them for me.
The update today, the market's fallen a long way, but the actual operational update was very good. They're producing buoyant levels of coal, both in Bengala, which is their original asset in New South Wales, and New Auckland, a new developing asset in Queensland. They're paying double-digit dividends at current prices. Like, I don't know what more you want from your stocks. I'd be happy to sit there and collect double-digit dividends. If this thing never rose again, you'd still get perfectly adequate returns from here, just from collecting the dividends. So, yeah, it's a strong buy for me.
There you go. If you'd like to listen to that extended version, you can do so on our website. Just look up at the top bar for, I wish there was a better way to explain that, for our series, and you can see the stocks of the day there and catch up with any ones that you may have missed. Let's get across some of these market leaders today. Gold space, no big surprise. Evolution Mining looking really good. It's up by about 3%. PEXA Group did update the market last week, up by 3.6% today, and you can see there some other gold exposure. On the flip side of the coin, we've got some losses being felt in the lithium space. I don't see any news associated with Liontown. It's off by 16%. Clarity is down by 12%. Just a very volatile stock. And MinRes, we heard about the appointment to the board, not helping the share price at all, off by 9.6%. And Breville down by 7.4%. Again, not seeing news, but it might be just a sentiment thing, and particularly because we're seeing China retail sales slowing. Into the small end of the market, Mayer Resources down by 22%, up by close to 22%. Electro-Optic Systems had a sale. So it will be selling some of its, I don't want to misspeak, but yeah, it definitely had a sale, up by 13%. Flipping the page though, and Echo IQ was down by close to 24% before being placed in a trading halt. It failed to get some sort of a designation from the American Medical Association. Apparently it's just, an exercise that they can revisit. It's not, curtains for the company or anything, but yeah, big fall there. And Appen off by close to 15%. If you remember, Appen was the stock of the day on Friday. It absolutely soared. I think it was up by like 26% or something. So a bit of give back today. Tonight, we get inflation data out of the EU. It's expected to be stable. The US Conference Board Leading Index also out for the month of April. It's expected to ease by about 0.8%. It's all about the interest rate decision tomorrow here, isn't it? We will be watching T&E Technology One. It's out with its earnings report. Light & Wonder holding an investor briefing. But more interestingly, we'll be speaking with the CEO of Technology One. So I hope you can join us for that. Final check-in on this market. The COB Australia Index shed 0.6%. The S&P ASX 200 also shed 0.6% to land at 8,295. USE minis still coming under pressure. We'll be watching for the gold price overnight, oil as well, and those 10-year treasuries. What will happen next when the U.S. opens? We will get you all across it when we are live from 9:45 a.m. tomorrow.